大家好，欢迎回到我们的会员节目。今天有幸请到了一位现役的这个基金经理，他同时呢也是一个基金的 managing partner。在我个人的职业发展或者说学习当中呢，Sri 的确是让我学到了很多的东西，所以我也把他看作我的这个导师 mentor 之一。这个俗话说，贵人都是可遇不可求的。今天呢，大家就遇上了，因为我想把他的一些观念通过这个采访的形式传递给大家。因为不管你的自学能力有多强，听一听这种经历过牛市也经历过熊市的专业投资人，他们的这个意见，他们的这个职业养成，我觉得还是非常非常的有价值的。那就让我们一起来欢迎 Sri 来我们的节目做客。So, Sri, thank you for joining our show today. It's a great honor to have you on the show to get some perspective from an actual professional. We have you here today to talk about the gold and silver market, but before we get into that, could you share a little bit with us about who you are and what you do professionally?
Sure. Happy to be on here and thanks for having me on. My name is Sri Kargatkar. I work at Sprott Asset Management. I'm a senior portfolio manager and a managing partner at Sprott Inc. And I have been in this industry for 15 years. I've been investing on my own for much, much longer than that. And I've been able to, over the course of my career, have a perspective on things which is hard earned is probably the right words to describe it, because I've experienced the highs, the bear markets that followed from 2011 all the way down to 2018, and subsequently also been enjoying some of the bull market. So it's a bit of a interesting view in that my career has been long enough that I've been able to see a market cycle or two.
Sri, you've been through both bear and bull market. So how do you deal with the bear market? If we can shift our attention to that discussion a little bit, in your bear market, how do you deal with losses? Do you take losses or do you prefer to cut them early?
So bear market, there's nothing quite as vicious as a bear market in the commodity cycle, because oftentimes things that could have been worth $100 at the peak of the cycle can be sold or sometimes get sold for $1 or $1 for every $100, or sometimes even lower than that. So the highs are quite spectacular, but the lows can be exceptionally vicious. So the way that we used to navigate through the bear markets, and we probably will going forward, is to look at how the portfolio is positioned, and we primarily just invest in publicly traded equities. So it is important to understand what the portfolio is positioned in, what the liquidity of these companies is, because oftentimes it's the illiquid companies which are punished the most. And the second thing to also keep in mind is, what is the thesis that brought you into any particular name? And is the thesis still valid today as it was a year ago or 2 years ago? And if that is the case, perhaps it is worth waiting for this company to emerge from the bear market and onto the other side when better valuations can be reasserted. But in some instances, the thesis can completely change when the commodity prices move significantly against you, or balance sheets can change, or just the operating environments can be changed for the negative. And those are the periods where you have to be really careful and perhaps not own a company like that, and move into companies with better liquidity and perhaps a more defensive approach towards doing business in a bear market cycle.
Yes, that all makes sense to me. Thank you for that. How do you deal with the psychological aspect of investing? You just explained to us, from a investment fundamental perspective, you have to focus on your goal, focus on what brought you into the stock in the first place. But we're all humans, and in a downturn, we get emotional. How do you deal with that specifically? What would you say is the biggest difference between an institutional portfolio manager and a retail investor?
When you're looking at it from a psychological point of view, it is easier said than done is the answer, because like I said, the highs can be really high, and you feel euphoric, and it feels like nothing can go wrong. And then there's the lows can be the opposite. they're violent, they're extremely frustrating. There's a lot of anxiety that happens during a bear market. So what I have always tried to do is when things are good, I keep telling myself, this too shall pass. And when things are not going so well, I keep telling myself, this too shall pass, which allows me some degree of being able to dissociate myself from the here and now. If it's a bear market, all the red that you see on the screen, or if it's a bull market, all these massive wins that are coming across the screen. So to be able to dissociate from it and look at it from a more objective manner. Again, going back to making sure the thesis on any given equity is still sound. If the fundamentals are improving, or if things are changing under the surface that perhaps it's not getting reflected in the share price, but could result in a position being subtracted or added to.
How did you manage to build up this set of skills and knowledge? Did you already know these things when you first entered the business, or did you have a phase in your career where everything just came together and clicked together? Was there some sort of turning point?
I don't think that to describe something from a perspective of, oh, was there a turning point? Have things just become exceptional all of a sudden? The answer is no. I'm always trying to learn every day. There's the market has a pretty mean way of making you or reminding you that you're only human at the end of the day, and every human is prone to mistakes. And the thing that I always try and focus on is just to, like I said, the most important thing is just to remind oneself that good times are always going to pass, bad times are always going to pass, and it is the person that has the wherewithal to be able to stick through the good times and the bad times that is able to and stay invested through the long haul, that they can actually see those massive life-changing type of investment returns, which are possible, especially the commodity cycle or in the commodity market. But it is not something that one day I just realized that it is, hey, I've become that, you know. It's one day I didn't wake up and become the Yoda or something like that. There's no such thing. So there's still many days where there's lots of positive emotions. There's many days with a lot of negative emotions. But as you age, perhaps you become a little bit more patient. And maybe that's the one thing that has changed for me.
Right, so it sounds like it's an ongoing process, and finding good education, finding good mentors can definitely help speed things up. So Sri, I wanted to shift a little bit towards the gold market. During the 2011 to 2019 market, gold was basically flat. Also during that time, the US government has been printing money and doing their QE, devaluing their dollar, but gold didn't move up all that much during that time. So what changed after the bull market got reasserted?
So I would say that the low probably came around the end of 2015 when the price of gold was just around $1,000 an ounce. And to put that into perspective, the highs that we saw back in 2011 were north of 1900. So the price of gold got cut down almost in half through the bear market. But what started to change going from the end of 2015 into 2016 and onward are a few things. We started to see the interest rate environment interest rates started getting hiked at the end of 2015. And that was something which investors had perhaps over positioned for, in that they were thinking that, oh, if interest rates go up, the price of gold has to get sold down. And this is where the market perhaps overcorrected. And the hikes that we started to see, it actually what became a buying opportunity for investors at large, as perhaps maybe people that had shorted the gold bullion into that were covering, and then we start to see ETFs start to pile in as well. But the most important thing that happened, two most important things that happened between 2016 to now, is that during COVID, we had stimulus, the levels that we have never seen before. It actually dwarfed the amount of money that was put into the system during the 08-09 financial crisis. So that was number one thing. And the second thing that also happened was that the US government and the EU decided to freeze the assets that were held by by Russia after the invasion of Ukraine by Russia. And this move was something which a lot of countries looked at and said, while today we might not be in the bad graces with the EU and US, and there is no certainty that the reserves that we hold that are denominated in US dollars or euros are completely safe from being frozen in the future. So more and more central banks have begun to move towards the asset which they don't have to worry about if it's aligned with the US, if it's aligned with China or what have you. They're choosing a neutral asset, and gold is the only neutral asset that is held by central banks, because everything else is treasury bills or certain currencies of different countries around the world. And up until a point perhaps where central banks might start storing other metals or other commodities, but gold is the only commodity which is held as a reserve asset. And that particular asset started to become more and more important. And we have seen massive levels of central bank buying, especially starting in 2022. And obviously, since then, we have also seen a fair bit of investor enthusiasm coming into this space as well, especially out of China and India as well. And that's been important. And the other area which people are perhaps not paying enough attention to is the amount of gold that is being purchased by some of the crypto platforms, like Tether, for instance. The Tether gold stablecoin currently has a market cap in excess of $2 billion. And that is a lot of gold that is being absorbed by that particular platform, brand new platform, which did not exist before. So it's just a cumulative number of new buyers that are persistent and perhaps care less about the price paid and more about what the value received, the value proposition of gold. That's really changed things for the better, starting from the bottom that we saw in 2016 to today.
Thank you, Shri. If I sum up what you said, the gold buying by central banks is due to geopolitical tension, and there's also technical advancement in this marketplace that brought in new buyers such as Tether. Currently, it seems like central banks aren't really stopping their gold buying spree. What do you see in the future for gold?
I think it is safe to assume that, generally speaking, there are more and more countries, and these are countries with sizable economies, such as China, such as India, South Africa, Brazil, and I'm talking about the BRICS nations, and plus all the new countries that are coming in. They're starting to recognize that they can't just keep trusting the US dollar on an indefinite basis. So while many recognize that the US dollar is still a very important mechanism of settlement of trade, there is perhaps starting to become, I guess, people are starting to realize that there needs to be a better mechanism for overall settling of the trade balances. So that's why I think we have started to see more and more central banks purchase more and more gold. And it would not surprise me if in the future years, countries decide to perhaps use fiat currencies to settle the trade, but then the trade deficits perhaps start to get settled in something more physical, like gold bullion, for instance. So I think that could be something, a scenario that we're moving toward. Again, this is just very hypothetical, and it's just me talking out loud.
So you mentioned Bitcoin. I wasn't going to ask this question, but I do want to ask this question now. People say Bitcoin is the electronic version of gold. Do you agree with that? If not, why?
I can't frankly state that I'm an expert on anything crypto. So I've typically tended to like assets which I can drop on my foot and hurt myself with. So when it comes to crypto at large, unless it has a backing of something which is perhaps more widely accepted, be it gold, be it silver, or something like that. I find it pretty hard to be able to put my hard-earned after-tax dollars or whatever currency that I have into that particular asset class, not knowing as to who controls it on the other side, what type of volatility can I expect, and whether or not if I go to someplace, go on a vacation, for instance, that the person on the other side will be would willingly want to accept the crypto versus whatever currency I have in my pocket. So frankly, I don't know whether or not it is as good as gold. I'm sure there's people that are much smarter than I am that have a more nuanced point of view towards all this. But like I said, I tend to be gravitated towards asset classes which have that solidity to them.
Would stocks be considered solid for you?
Stocks are investment speculations, what have you, right? So at Sprott, we typically invest in resources, and that investment comes through the form of be it physical metal, be it gold, silver, platinum, palladium, copper, etc., or through equities that are in the business of mining that metal and generating a profit out of it. So pretty much all equities, those are speculations, they are investments, and ideally they're productive investments where $1 today can be worth $5 down the road. So that's how I view it versus something which there's no rate of return attached to it, unless it's a stable, trusted form of savings vehicle.
Since we're on the topic of stocks, so gold miners, year to date, they're up around 130%. Gold itself is up nearly 60%. At the current gold price, investors argue that the valuation of gold miners are actually cheaper now compared to before. Could you break down this mechanism for us and for the viewers, please?
So I would say that we had touched on equities before, and these companies that are in the business of mining for gold. And I'll lay out a very simple example for your audience. If the price of gold is $2,000 per ounce and it costs a company $1,000 per ounce to extract it, they're making $1,000 of profit for every ounce that they're able to extract and sell into the market. Now, if the price of gold goes from $2,000 to $4,000 per ounce, and their cost of doing business is still $1,000, the profit that they can generate by selling the same ounce has gone from $1,000 to $3,000 per ounce, which is a tripling of the total profitability. Obviously, costs don't tend to be very stable. They will rise, but what we have seen over the past 3-4 years is that the price of the metal has far exceeded the cost of doing business. And so in many instances, we have seen the earnings for these companies significantly rise as a result, triple digits in many instances on a year-to-date basis versus where things were when 2025 began versus where things are right now. And that is now getting started to be reflected in the price of these equities, that, hey, all these stocks are significantly more profitable than they used to be. But what has not changed, and in many instances what has changed is that the multiple that you pay, so call it EV to EBITDA, free cash flow yield on a company, in some instances they have actually gone down, which means that the stock is cheaper today as a result of the price of gold having gone where it is, and the profitability increase that they have seen. So it's cheaper today on a multiple basis than it used to be when the year began or a couple of years before. So to your point about some people in the community stating that gold stocks are cheaper today versus where they used to be, perhaps at the beginning of the year or a few months ago, I would absolutely agree with that. We have not yet seen big re-ratings in the multiples of these companies. And we tend to see that as the bull market starts to mature and people begin to pay up more for that dollar of earnings that is being generated by a company.
And it sounds like you seem to think that the trend will continue on and is nowhere near the finish line, or so to speak, top, right? Where are we exactly in this bull market?
It's really hard to speculate on it. My view on this particular stage of the bull market is, and I've written about it, is that we're still in the earlier innings, and I say that because we have not really seen any real capital come into the space yet. So if you look at the units that are outstanding on the GDX, if you look at the units outstanding on the GDXJ, they've actually declined year to date by a substantial number, which means that people are actually redeeming their GDX investments or the GDXJ investments. And the same thing can be said for many actively managed strategies as well. So usually when the bull market begins to mature, we're in the middle innings and later innings, the capital flows are positive because people are optimistic on how the market is trending, and they're optimistic that if they make $1 investment today, they can have a nice return on the other side. And that optimism has not yet entered the picture, which is quite interesting despite the big returns we're seeing.
So are investors just staying on the sideline? Because in terms of global asset management allocation, gold isn't even 5% of the entire portfolio. If allocation to gold goes up, theoretically, the bull market should continue on, right?
I would agree with that. I think that we're in a situation where there's capital coming into the bullion ETFs, so the GLDs, some of the ETFs that we have, for instance, products that we have, for instance. But there has, like I said, there's been money flowing out of the equities. So we are at an interesting juncture in that there are investors that are starting to pay attention to the space, but they are not yet convinced that the volatility that we used to see in the mining equities is something which can help them rather than hurt them in the coming months and years.
Got it. That makes perfect sense. Let's shift to silver a little bit. Currently, the gold and silver ratio is around 80, which is a little bit higher than the 5-year average. And recently, silver has been outperforming comparing to gold. So could you break it down for me a little bit? What is the main difference between gold investing and silver investing, of course, besides the color?
And besides the fact that they're both precious in my estimation, I would say that silver, by and large, is viewed as an industrial metal today. Most of the silver that is extracted out of the ground ends up being used for an industrial use or for like manufacturing of something. Very little silver actually gets put into a vault as silver bars. And that's the swing factor. When investors choose to put money into silver and hoard those bars, and that piece of the pie starts to get bigger, that's your swing factor in terms of how tight the market can get and where the price of silver can go to. We've not seen massive dollars enter the silver market at large in terms of investment dollars. But what has certainly been changing is that the total amount of demand for silver, and we're talking about industrial demand, has been quietly rising in the background. And we have seen multiple years where the mine supply has not been able to keep up with the total demand for silver. So we've been running deficits. And when you run deficits, the above ground stockpiles are used to fill the gap. And those stockpiles that are above ground are now starting to get to a point where the deficits will start to, we think, translate into higher metal prices. Because if there's just not enough metal to go around, all these manufacturers who require silver for whatever purpose they're going to be using for, maybe making an iPhone or some electronic item or for solar panels, they have to compete for that metal, and they will start competing for that metal on price if not enough metal is available. And we saw that happen in the palladium markets when the above ground stockpiles were dwindled, and once those stockpiles disappeared, the price of palladium went from, I think, $600 per ounce to north of $3,000 per ounce. So we're starting to get close insofar as silver is concerned, and I think that in the coming years in particular, if investors begin to pay more and more attention to what's developing on the physical side of silver, and they start to allocate more dollars to buy silver bullion or silver ETFs, we're quite likely to see a big response on the price side as far as silver is concerned.
Got it. So there's been a bunch of rumors on the street saying how the Wall Street people is controlling or manipulating the silver price, basically keeping it under 50. Do you have any opinions in regards to stories like these? Are they just made up conspiracy theories, or are there some sort of truth backing up the rumors?
Well, I think there have been a few instances where people were caught and fined and jailed in the past few years. So this is not really myths or hearsays. There certainly has been an element of market manipulation. But that being said, you manipulate markets with the short term. But when you look at it or what transpires over the long term, it's more difficult to keep the markets manipulated for a long term because things like supply demand, cost of extracting that ounce out of the ground are the factors that drive or determine the direction of which way the price of silver or for that reason any metal will go. So while there's always going to be some element of people playing games in the commodity markets, just like there are people playing games in the equity markets, I think over the long term, for an investor who has a longer view, the fundamentals are what determine the eventual price.
So Sri, as a personal investor yourself, do you allocate to gold and silver? If so, why?
Yes, is a short answer. I do own physical silver, physical platinum in a bank vault, and that's just my personal holdings. And I have a fair bit of skin in the game through my employment at Sprott for all things that are gold related. So in pretty much every aspect of my financial picture, all precious metals actually play a pretty significant role.
Are you a buy and hold investor? Do you use any derivatives to hedge or anything fancy?
There have been periods where I've done derivatives trading, but what I've come to realize is that the big gains are to be had not by trying to clip a 5 or 6% coupon. It's by developing a thesis on a particular security in terms of where it trades today and where it can trade to should the thesis work out, measuring how the company is operating and delivering on that thesis, which you had when you purchased a particular security. And if the answer is yes all the way along, you don't sell the stock because your thesis is still playing out. There comes a point in time where perhaps the price of the security goes well through whatever price you had originally come up with. And again, this is adjusted for the commodity price changes, the operating cost changes. In which instance, if it goes well above where you think it's possible, it would be silly not to take some gains in that security. And vice versa, if the thesis is not playing out, if we're talking about an exploration company that has strong initial success that is not followed on by similar caliber of continued exploration success, maybe you need to rethink what got you into the security to begin with and figure out whether or not it is an investment you want to sit with for the long term. So something which I find a lot of the people pay less attention to is developing a point of view as to why do you own a piece of business. And more people pay attention to what is my ticker saying, which way is the price moving, is it going up, is it going down, rather than what is happening to the business itself that you purchased. So if people can begin to pay more attention to the fundamentals and less attention to the short-term price movements, they might be better served by that and perhaps enrich themselves even more so.
Where do you think people should start? If I pretend I don't know anything about investing, this is my first day in finance, where can I start if I want to gain some of this knowledge?
Read is the number one advice I can give anyone. You have to be able to pick up a book and have that patience to actually sift through the pages and pick up a thing or two that perhaps you can apply in terms of your overall set of knowledge that you have to build up. And I started to invest on my own since when I was 19 years old. And the first couple of stocks that I bought went to zero, but that didn't really stop me from continuing down the path. All it made me more curious. So I started reading on various different portfolio managers who have been so kind as to put their thoughts on paper and allow the rest of the world to learn from them. So it doesn't matter whose book you read, and like if it's Peter Lynch or if it's Charlie Munger, if it's some of the books that are written about Warren Buffett, Howard Marks. There's just so many different portfolio managers out there, founders in many instances, who have done a great service for humanity by putting down on paper how they approach investing. And that's something that I think every person who has any aspiration of investing their money should always do, is to build up that base of knowledge and then slowly start applying some of these principles into an area of the market that they have a lot of interest in. And then slowly as the years pass, hopefully that particular set of knowledge continues to expand. You become a little bit more sophisticated, and the way you approach investing evolves with it.
Shui, what do you think about technical analysis? The reason I ask is because technical analysis is the most commonly used tool among retail investors. I have some idea as to why that is, because it's easy. I think people can see the chart and feel a sense of control. But from your professional view, what do you think about technical analysis, and do you use it personally or professionally?
When you go outside of the door, it's always useful to know if it's raining or if it's sunny. And I think having an understanding of what's transpiring in the prices of whatever security is important. So I don't think that technical analysis per se is complete hogwash. It can be if you let it be, but I think it is important to perhaps marry fundamental analysis with a little bit of understanding of what's happening under the surface from money flow perspective. Is capital coming in? Is capital leaving? We're talking about the GDX and the GDXJ outflowing before. And then what is happening on the multiple side of things? Are the multiples increasing? Are they decreasing? And these are all the kind of things that you can see pictorially on a chart. But everyone just gets attached to the price. And obviously the price of any given security or commodity is also important. So I can say technical analysis on its own is a useful tool that everyone should have. And there are certainly people that purely use technical analysis and have done well, and good for them. I tend to look at things on a fundamental basis first, and then also try and figure out, are there things happening technically that are worth paying attention to? Are the multiples increasing? Is money flowing out? If my thesis on a stock is correct, and if I think the stock goes from 1 to 5, is it, as the company's delivering on things, is it going from 1 to 2 before it goes to 5? So those are the kind of things that it does help an investor keep on top of. And the other area where technical analysis can also be sort of useful is when your thesis is just not getting reflected in the price of the shares. Now that's where you can actually come away with more questions. Is there a big seller out there that's pressuring the stock, or is there someone that is a smarter person that is more informed, that has a different point of view than you do? And those are the kind of things that oftentimes keeping an eye on price movement, volume movement can inform an investor about it.
Sri, we discussed a little bit about the fundamentals, about the technicals. These are risks relating to a specific company, or also known as non-systematic risk. Currently on the market, there are ETFs for just about anything, which kind of helps with the diversifying non-systematic risk. Would you say that is a good strategy to go with, perhaps for someone who doesn't have a lot of time to study the markets?
I think that's certainly the right way to go. And in fact, I think a lot of the big institutions do that. So if a large pension fund, for instance, wanted to get allocated into gold miners, for instance, the simplest way for them to get allocated would be to purchase either basket of stocks, which are the largest components of the gold mining index, or just to buy the index out at large. And then if it's a thematic that they want to stick with, and they maybe want to generate some alpha in addition to that, they might start to come down into the individual securities. But that being said, for an everyday investor who does not have the time or the expertise in some instances to dig through the details on every single company, it certainly makes sense to get the exposure through an ETF, for instance. So I would never tell someone to not look at an index fund or something along those lines. The area of the market that I always am a bit skeptical about are the leveraged ETFs, because when you're getting into a double levered sector ETF or a levered equity ETF, I think there's single equity ETFs that have been introduced with leverage built on top. You really have to do your homework and understand what you're buying, because many times I've come across individuals who buy it because they think it's going to go up. And many times, what ends up happening is that they don't know what they bought. So when things don't work out and things actually go down, their losses are magnified 2-3x to the downside. And that particular trade now becomes a painful investment lesson. And it's something that people should be very careful about, especially when they're dealing with leveraged ETFs.
Do you manage any ETFs, or what kind of funds do you manage?
So Sprott has several ETF offerings, and there's a couple of different actively managed ETFs that we have launched. There's a gold, Sprott Gold and Silver Miners ETF called GBUG, GBUG, which is an actively managed ETF, and I'm one of the portfolio managers on it. We recently launched a diversified metals and mining ETF, which is actively managed, called METL. It goes on the ticker METL. And so those are two actively managed ETFs that Sprott currently offers.
For those in the audience who wants more of your expertise or perhaps wants to invest with you, are you open to those options, or do you strictly deal with institutional investors only?
So I don't manage one-off investors, obviously, but what I would recommend is if someone wants to know more about our firm, they can go to sprott.com, SPROTT.com. And there are different ways of getting in contact with our salespeople who can help you figure out the product or a product suite that might be right for your needs insofar as resource investing is concerned.
Thank you, Sri. I think we're coming up on time. I want to thank you for joining our show today, especially, so generously sharing your knowledge, sharing your experience with us. Really appreciate you joining us today, and wish to have you back in the future, maybe perhaps when we see a higher price in gold.
It's a pleasure being on. I really appreciate you having me on, and wishing you all nothing but the best as your viewership and your channel continues to get bigger.